This is Macro Horizons, episode 362. It's Not a Leap, presented by BMO Capital Markets. I'm your host, Ian Lyngen, here with Ben Jeffery to bring you our thoughts from the trading desk for the upcoming week of February 23rd. And as the end of February arrives, we'll note that it's not a leap year. There's no need to square the difference between the astronomical year and the Gregorian calendar this weekend. Which begs the question, why do we add an extra day to February? August 32nd sounds good to us. Each week, we offer an updated view on the U.S. rates market and a bad joke or two. But more importantly, the show is centered on responding directly to questions submitted by listeners and clients. We also end each show with our musings on the week ahead. Please feel free to reach out on Bloomberg or email me at ian.lyngen@bmo.com with questions for future episodes. We value your input and hope to keep the show as interactive as possible. So that being said, let's get started. In the holiday-shortened week just past, the Treasury market put in an impressive performance that saw 10-year yields drop as low as 4.016%. The market fell short of shifting into three-handle territory, although as the process of consolidation continues to unfold, it would be very reasonable to anticipate 4.0% is tested sometime in the coming weeks. Now, clearly, for such a bullish outcome, there would need to be a more sustainable downshift in the fundamentals. As it currently stands, the FOMC minutes reinforce the notion that the committee will be on hold until we see further progress made on the inflation front. This represents a shift from what had been an emphasis on the employment component of the dual mandate. With inflation arguably back in the driver's seat, it's notable that the Fed's observation that labor market conditions have stabilized were reinforced by this week's initial jobless claims print, which dropped to 206,000 for the week of February 14th. Keep in mind that this was the non-farm payroll survey week, so this is an informative departure point for estimating payrolls growth in February. It's also worth noting that 206 represented the 5-week low for the series. We also saw some of the trade numbers come in, revealing a wider trade deficit than previously estimated. For the month of December, the figure was $70.3 billion compared to $53 billion in November and expectations for $55.5 billion. Imports jumped 3.6% compared to a forecast of just 0.1%, and exports slipped again by 1.7% month over month compared to the decline of 3.4% in November. On the margin, the recent shift in the trajectory of the trade deficit implies a headwind to real GDP in the first half of 2026, assuming, of course, that there's not a reversal. As we saw over the course of 2025, there were notable fluctuations in the trade deficit based largely on a recalibration to the new tariff structure and the ongoing trade war. Also of note in the week just past was the continued flattening of the yield curve. 2s pushed up against 60 basis points, roughly a 15 basis point flattening off of the local peaks. This resonates insofar as the bulk of the buying demand was a duration story, given that the 2-year sector remains largely wed to monetary policy expectations, and we're content to see the front-end benchmark remain in the orbit of 350 for the time being.
Even though it wasn't a week with any top-tier economic data, and between the Lunar New Year and Monday's market closure, it was generally a lighter activity trading week in the Treasury market, there doesn't mean that there weren't some important takeaways revealed simply from the price action itself. Specifically, we saw 10-year yields continue their decline as the bullish sentiment that continues to reverberate throughout the bond market brought yields as low as 401 and decidedly within striking distance of a 3-handle, as the market continues to contemplate risk asset valuations, what AI might ultimately mean for the labor market, and the fact that while 10s aren't at 450, in an environment where the Fed and the Treasury Department both seem bound and determined to bring rates lower, a U.S. 10-year yield that's still above 4% isn't such a bad buying opportunity, and that's not even taking into consideration some of the bigger economic and geopolitical risks that continue to simmer in the background.
And it's with that backdrop that I think that the process of consolidating with 10-year yields above 4% but below 4.20 follows intuitively given the severity of the recent macro rethink and subsequent bid for treasuries. To some extent, there's an argument to be made that while the official BLS data showed a solid 130,000 jobs added in January, the private data, including ADP, Challenger, and Revelio Labs, has been consistent with a softer start to the employment market for 2026. When we add in the fact that retail sales disappointed, this all reinforces the notion that there are mounting headwinds for the real economy, and while no one is talking about a contraction or a recession, there's a compelling case to be made for a return to trend growth, which is roughly 2%, as opposed to the very solid showing that the U.S. economy put in during 2025. It is important to keep in mind that a lot of last year's big fluctuations in growth came as a function of the trade war and the shifting tariff landscape, as well as fixed investment associated with the AI build-out. Now, with the AI story back in the headlines and leading to rotations in the equity market, it will be notable to watch the performance of risk assets in this environment. A meaningful correction in the equity market would tighten financial conditions and presumably undermine the outlook for the top 10% of households, which continue to account for roughly 50% of consumption in the U.S.
And we also found ourselves in an interesting client conversation this week around how that dynamic may play into what could be a slightly different reaction function to a risk asset-driven tightening of financial conditions under the Warsh Fed, specifically the idea that maybe Warsh and Bessent are going to be willing to tolerate more downside in equities than has been the case under prior regimes, simply given the focus on avoiding asset price inflation and instead stimulating the economy via lower rates in the long end of the curve and providing easier access to credit to catalyze real economic activity. Now, obviously, in the event of a sharp correction or quick entrance into a bear market in the S&P 500, one would expect to hear from the Fed chair, regardless of who it is, but the fact that there's been such a clear emphasis and delineation between asset price inflation and actual demand-driven, consumer-driven inflation from Washington could suggest that there'll be a greater tolerance for risk asset weakness from the new Fed than there has been under previous regimes. And so as we think about what that means for the wealth effect and for the drivers of consumption, it certainly adds to the case for the point you made, Ian, that perhaps growth is not going to continue at 5 or 6% throughout the entirety of 2026. Obviously, the outstanding question remains how a potential boost in labor productivity resulting from AI or not ultimately flows through to the labor market, to wages, and overall growth. But it's safe to say, as we enter this new paradigm with greater collaboration between the Fed and the Treasury Department, the traditional reaction function between equity prices, financial conditions, and an FOMC response may not necessarily hold in this new paradigm.
There's also an ongoing debate whether or not the productivity associated with AI should increase the Fed's estimate of a neutral rate, decrease it, or have little impact. As a takeaway from the January FOMC minutes, clearly the committee believes that over time, AI will be disinflationary. The flip side is how do the productivity-enhancing aspects of AI help bring in investment at the cost of savings and continue to contribute to the run-up in equity valuations that has arguably contributed to the durability of consumption, particularly for the upper quartile.
And along with the moves in risk and treasuries this week, we also got the minutes of the January FOMC meeting, which, even though the market didn't really seem to care, struck a decidedly more hawkish tone than what we've heard from Fed officials recently. Specifically, the minutes discussed some upside risks to inflation and generally more concern about the path of consumer price growth, instead of the angst around hiring that has been more in the driver's seat in terms of driving the discussion at the Fed lately. Now, as it relates to a March cut, especially with NFP, CPI, and a look at the collective sentiment on the committee in hand, it's extremely unlikely that Powell's going to feel compelled to bring rates lower next month, and there's a growing case that we may have seen Powell's last cut last year. And the fact that within the minutes there were some committee members that were even starting to maybe potentially think about the potential for hikes, that is a meaningful shift in the discourse from what dominated the monetary policy discussion last year. Now, how long that persists with the Fed under new management remains to be seen, but the combination of the growth outlook and the latest labor market data clearly has some on the committee a bit more concerned about a reacceleration of inflation than has been the case in at least a little while.
Well, to be fair, we knew going into the January meeting that there was a clear division between the hawks and the doves, so it's not that surprising to see some a bit more concerned about reacceleration of inflation and therefore advocating for some more balance around the forward guidance on policy rates. Nonetheless, the bulk of the committee clearly still sees lower rates as the path of least resistance, and in that context, the debate regarding what neutral policy truly is remains relevant. We're operating under the assumption that the messaging that 3% is a long-run, let's call it target for policy rates, gives us a rough estimate that the Fed has about another 75 basis points to go before the market is convinced that the journey towards neutral has been completed. As you pointed out, Ben, the minutes also made it pretty clear that we're no longer skewed toward the employment component of the mandate, and instead, the committee is more balanced between employment and inflation. One could argue that some of the language suggested that inflation is back in the driver's seat. Specifically, the observation that lower policy rates would be warranted as long as inflation continues to ease as expected. As a result, investors will, appropriately, be focused on the incremental inflation data as well as the employment anecdotes, and of course, the BLS's employment report.
And lastly, in an otherwise relatively quiet week, one of this week's highlights was what we saw at the 20-year auction, which tailed 2 basis points in what was an impressive mirror image of what we saw at the 30-year auction, which stopped through 2 basis points. Now, part of this is surely a function of simply the outright level of yields and the rally that has continued since the 30-year auction and the implicit buying that has taken place between then and now. But the result was more interesting given the continued focus on the 20-year point of the curve and how it may, or may not, fit into Besant's issuance plans over the longer term. Now, do we expect there's an imminent announcement at the May or August refunding announcement that 20s are going to be eliminated from the issuance slate? No, that's probably a bit extreme at this stage, and if that were going to be the case, one would probably have expected a stronger auction result on Wednesday. But nonetheless, as the conversation around issuance continues to evolve and how the Treasury Department is taking a more active, regular, and predictable approach to long-end issuance, at a minimum, the 20-year is still going to be a topic of conversation as a measure of sentiment on the likelihood that we ultimately see the next move in long-end supply lower, not higher. Now, that's not really up for debate in the 2, 3, and 5-year sectors, which are slated to be the first sectors on the list to increase. We're expecting either at the August or November refunding. Looking ahead at 10, 20, and 30-year auctions, as a measure of what participants in the primary market think about the distribution of risks around issuance going forward, 20-year auction performance could be a bit more indicative of sentiment than would otherwise meet the eye.
Like they say, don't waste your 20s.
Having spent a large part of my 20s recording an interest rate podcast, I can attest to that.
Not a waste. In the week ahead, we anticipate that the Treasury market will continue with the process of consolidation with 10-year yields between 4 and 4.20 as the market gets more clarity on the stance of monetary policymakers, and there will be a variety of Fed speak that we anticipate will lay out both the dovish and the hawkish cases for policy going forward. Waller kicks off the discussion on Monday morning, and recall that he dissented in favor of a rate cut at the January meeting. So, in light of this array of Fed speak, we're wary that the bulk of the price action could be concentrated in the front end of the curve. This notion is also reinforced by the auction schedule for the week ahead. We have 69 billion 2-year notes on Tuesday, and that will come following Tuesday morning's full slate of Fed speak. We also have 70 billion 5-years on Wednesday, and February's auctions are capped by 44 billion 7 years on Thursday afternoon. Keep in mind that it's the end of February, and as a refunding month, the extension and related demand will be relevant in the run-up to the weekend. We also see January's PPI numbers. Not only do we see headline PPI, which is forecast to increase 0.2%, but core PPI is similarly anticipated to have gained just 0.2%. Now, while PPI remains relevant in forecasting core PCE for January, the slightly lower than expected headline CPI at 0.2% for January has already set the tone for the market's take on inflation as 2026 got underway. As is always the case, we'll also be watching the weekly initial jobless claims numbers on Thursday. However, given that it's not NFP survey week, we're less likely to see sharp price action as a result. Instead, with a backdrop of consolidation for duration and the potential for greater volatility in the 2-year sector, we'll be watching the shape of the yield curve, most notably 2s, 10s, with expectations for any weakness in the 2-year sector to translate into further flattening pressure with an eye on the 60 basis point level for 2s, 10s at the moment. We've reached the point in this week's episode where we'd like to offer our sincere thanks and condolences to anyone who has managed to make it this far. And as many regions face fresh winter storms, we continue to lament the results of Groundhog Day. Again, and again, and again, and again. Thanks for listening to Macro Horizons. Please visit us at bmocm.com/Macro Horizons. As we aspire to keep our strategy effort as interactive as possible, we'd love to hear what you thought of today's episode. So please email me directly with any feedback at ian.lyngen@bmo.com. You can listen to this show and subscribe on Apple Podcasts or your favorite podcast provider. This show and resources are supported by our team here at BMO, including the FIC Macro Strategy Group and BMO's marketing team. This show has been produced and edited by Puddle Creative.
The views expressed here are those of the participants and not those of BMO Capital Markets, its affiliates, or subsidiaries. For full legal disclosure, visit bmocm.com/macrohorizons/legal.